What's up, guys? I'm filming back to back again, and I said I will get into bonds, so let's hop into it. So, this time I'm just going to give you guys information on bonds. I'm going to try to make this simple, short and sweet, explain it the way that anybody can understand it if they want to invest. Now, bonds, typically, a lot of people don't buy. A lot of people say, I'm just here to invest in common stock, get a lot of capital appreciation. So, let's get into bonds. So, bonds, you're a debt holder. It's a contract, it's an agreement. But let me read from the book, give you a simple term. When you buy a bond, you are lending money. You are lending money to an organization, whatever it is, the government, a corporation, municipality. And bonds differ from the stock because it's not ownership. So I said it's a contract. That's what I learned in finance class. It's a contract. So it's a debt security, and the investor is a creditor, which means that you receive interest payments for lending your capital. So it's an agreement between you and whatever entity is that I'm lending you money. So you have to pay me interest for lending you money. So par value. Par value is usually $1,000. That is the actual value of the bond. Now most bonds may be at a discount, a premium, but par value is always $1,000. So increments of 1,000. That's why the principal or par value of bond is $1,000. Coupon rate, or the interest rate of a bond. So when people say, okay, what's my coupon rate? What's a coupon rate? So it's a predetermined fixed rate that's usually a percentage of the par value. So let's say that you have a bond that is paid semi-annually, twice a year. So your coupon rate is 8%. So let's say the bond is trading at par value. So you get $1,000 bond, 8%. So you're like, okay, so how much will I get paid? So I'm reading here from the example. It says you will get paid $80 because you do 8% times 1,000, which is $80, and interest per year will be two $40 payments. So think about it. Annually, you'll get paid $80, but since it's semi-annual bond, you will get paid $40 every 6 months. Now you may be thinking, well, that's trash, but remember, they owe you first. If the company goes insolvent, if the company goes down underneath, you will get paid after taxes. So that's the contractual agreement, is a bond. And the maturity date, par value is also repaid. So let's say you hold the bond till maturity, you get your $1,000 back, and then also whatever interest payments you got, you just add that up and you're good to go with the bond. So bonds trade at, like I said, discount, par, and premium. So a discounted bond, as it says, the market price is less than par value. So par value is $1,000. So a bond at a discount, you get a lower price to go in, but it still has to get back to the par of 1,000. So it may have that chance for you to gain a lot more. Bond at par, $1,000. Trade at par, you get back par, cool. You just held a bond. Premium. Now premium, you have to pay over par, and premium bonds may be issued as callable sometimes. But I'm not gonna get too much in depth into that to confuse anybody. Just know if a bond's over 1,000, it's a premium. At 1,000 is par. Below 1,000 is discount. So here's the thing about bonds. You have a lot of different terms of bonds. I'm just gonna make it simple for everybody. Series bonds, different issue dates, but same maturity dates. So series, different issues, same maturity. Term bonds, entire issue of bonds has same maturity. So if somebody says a package of bonds for a term, they all mature on the same date. Whereas series of bonds, think about it as multiple series that you have to go through. Different issue dates, but the same maturity date. So think about, use this analogy, think about when sports teams have to go to the playoffs. There's all different seeds, but they all have to get to the same, they want to get to the same date, and that's championship game. So think about that, series bonds. Different seeds, different issue dates, different start dates. Some may start like in football. Some may start in divisional rounds. Some may start in the wild card. Different dates at the start, but at the end, they have to get to the same date, and that's the Super Bowl. Term bonds, entire issue of bonds, same maturity date. And I want to get into also the yield to maturity because I think that's really important. But before I get into that, I want to get into what are some good bonds. Before you say, well, what type of bonds do I invest in? So you want to go investment grade, not speculative, because as I learned in finance class, as I'm reading from the book right now, investment grade bonds, those are the better bonds. Sure, they may have a lower yield, but they are much more safe. You get a speculative grade bond, you get a junk bond. Basically, higher yield, but the company's also about to go underneath probably, most likely. Or in some cases, I don't know if Netflix has upgraded, but last time I checked, they were speculative grade. But I see it seems like they're doing okay besides some of the press that they have, but ultimately they're not investment grade. So let's just say triple A to triple B. So the ranking goes triple A, double A, A, triple B. And that's investment grade. So one analogy I like to use is that Big Baller Brand is the last line of investment grade. Triple B's. It's not copyright. I'm just saying Big Baller Brand. That's how I remember it. So BBB is the last line of investment grade. So BBB and above is great. Double B all the way to double D is speculative. That's bad. So maybe you want to understand what you're investing in before you take out a bond with Netflix, before you take out a bond Amazon. Think about the company. Are they good financially? If not, you might have a higher yield and be like, man, I'm going to get more money off this bond. But then again, that company might go underwater. Just to let you know. So, bonds. You have coupon rate, like I said, is what you get paid out, or the yield. So the yield takes into account the purchase price. So the coupon rate, like I said, is a fixed interest rate. So let's say you got the $1,000 bond, 8%, you get paid $80 per year, $40 semi-annually. Percentage of the par value. The yield is the rate of return your investor receives based on the price paid for the bond. So the coupon takes into account the percentage of par, percentage of 1,000. The yield is the price you paid. It takes into account the price you paid. So, discount bond purchased for less than par value, the yield is higher than the coupon because you're going to have to get to that 1,000 a little more. So the yield's higher than the coupon. The par yield equals coupon because it's at 1,000, the base. Premium, coupon is higher than yield because you're going to have to get back to that 1,000. So, for bonds, the main thing you need to understand is contractual agreement. You will get paid out in terms of the hierarchy second. Now, whether it's usually you're secured, and then if you're a general creditor, you're unsecured, so you get paid out second in terms of the hierarchy I said in last video. Bonds are meant for you to invest as a creditor, for you to say, hey, you can have my money, but you owe me. And it's contractual agreement. So bonds aren't necessarily for making money. You can make money off of bonds, but bonds are most used for helping a company out, saying, here's my money, you could lend it out, but you owe me, and you're pretty much backed by the contract agreement. Whereas you invest in a stock, like a common stock, you lose all your money. You can't do a thing about that, really. I mean, you could probably bring a lawsuit on for suspicious reasons, maybe something like that. But the grand scheme of things, you invest in a bond, you are more secured, but you don't get paid as much. But if you invest in common stock, you may get paid a little more, but it's more risky. So as a bondholder, you're a creditor. And that's the basic for bonds. So my thing about bonds is that you can invest in them. I would say look at bonds like treasury bonds. Look at those things when the yield curve is inverted. So you might be heading towards recession, or you like I said, the yield's pointing down. So remember that you can invest in bonds at any time, but you have to look at the maturity dates. You have to look at the yield to maturity. Don't always go for the highest yield to maturity, because you have to understand yield to maturity accounts the price you're going to pay for that bad boy. Whereas the coupon rate will account for the par value. So higher coupon, the better for you. But just remember, you might be paying at a premium. So you might pay more for it. And that's pretty much it for bonds. I don't want to do any more confusion. But just remember, you are a creditor as a bondholder, and they will owe you that money contractually. It's an agreement. So thanks, guys. I'll get into the next video. Appreciate you for watching, for tuning in. Thank you.